Very good morning. Welcome to Chartbusters. I'm Nigel D'Souza, and joining me as always is Mangalam Malu. Well, Mangalam, we're bracing for a bit of a downtick to kickstart trade. I think yesterday, we came off the high point of the day, so some part of the bad news, the weak overnight handover that we have was factored in. So we're defending this morning's lows. We're defending that 17,400 odd, but we'll need a bit of a tailwind actually to get past the 17,600 odd mark. Remember, that has the highest open interest. Today is when we have expiry as well that plays out. So 17,600 on the Nifty, and on the Nifty Bank, I'm looking at 40,600. Remember, we did a U-turn from those levels yesterday. But let's get straight to a couple of managements, and Havells, that's the one that's trading under pressure. Post the numbers, the margins, that was the big miss out there. Coming at its lowest we've seen in multiple quarters, or actually multiple years. Well, to understand what went on there, the chairman and MD of the company, Mr. Anil Rai Gupta, joins in to detail that. Hi, Mr. Gupta. Well, it was a bit of a tough quarter. On the positive side, good top-line growth, better than what the street was working with. You seem to have gained some market share as well. But let's focus on the concern first. Margins. The street is a little bit worried on that front. It's down to around 8% odd. Could you tell us whether or not the margins have based out? Point number one. Do we see a bit of a recovery from here? And point number three is, when do we get back to that 12-13% margin that used to normally deliver? Go ahead.
Thank you very much. Yes, we were quite satisfied with the revenue growth, and not only this year but also last three-year CAGR has also been quite good. I think going into the quarter, we knew that this will be a tough quarter on margins, and pretty much we know the reasons because last year we had seen unprecedented increase in the raw material prices. Of which not all the entire price cost increase was passed on to the market. In the second quarter, it was almost like a perfect storm where we have high raw material products, high raw material content products, and the prices now softening, which actually means that the ability to pass on to the market any cost increases of the past, or actually we're seeing some prices coming down. So it was more high cost inventory at lower prices, sale prices. We knew that this will happen in the second quarter. So we do believe that this is a trough for this quarter, because most of the old high-priced inventory is now out of the system, especially for the cables and wire business, where we saw drop in margins. And pretty much because the AC season was a low quarter for the second quarter, we do believe we still have some inventory left for the third quarter. Going forward in the fourth quarter, we will come back to normalized margins.
Gupta, just to understand that you're saying that margins have based out, right? We'll see some bit of an improvement in quarter three, and quarter four is when we return to normal levels. The normal would be what, around 12-13%?
Well, whatever, because we deal in different businesses.
Consolidated margins is what we would like to look at.
These will come back to normalized levels, and then consolidated levels are never at the same time. Certain product categories, different seasonal character to it. But overall, business by business, we should be back to normalized levels in the fourth quarter.
We take that point, Mr. Gupta. You had earlier indicated as well that the margins will only start improving from the third and fourth quarter. There would be some pressure in the cables business. You had said this at the end of the first quarter itself, and now that has happened in your communication. You've also said that the margins have troughed out. What we want to understand is that what would the nature of this recovery in the second half in margins look like across all segments? I mean, the first half, your cable margins is what, 6.8 odd percent, switchgears 25%, lighting close to around that 15% mark, and ECDs around 12.5%. So if you could give us a sense of the nature of improvement that one can expect in the second half of this year. I understand that you do not want to talk about the consolidated basis because different parts move in different directions. Just wanted your sense on all these different parts. And Lloyd's, when does that turn EBITDA positive or EBIT positive? Does that happen in the second half?
Yeah, I think in all the businesses that you mentioned, all the four businesses, the major reduction has been in the cables and wires business for the reasons I mentioned. So it should be coming back to normal levels, which is, in case of cables, is usually around 9 to 10%, which in the first half is about 6%. As far as Lloyd's is concerned, as we have seen, this was the toughest quarter. High-priced air conditioners, high-cost air conditioners being sold in a non-season business. We do believe that these will come back to full normalized levels, which will be double-digit contribution margins in the fourth quarter.
And on ECD business, I wanted to understand, in an otherwise strong quarter as far as the top line is concerned, your consumer durables business actually grew lower than the entire portfolio, and that's primarily because of destocking in fans. That business grew just about 6.2%. Going forward, what level of growth are you expecting out there, and is the entire destocking worry over and done with?
Yeah, I think in the entire ECD segment, Havells has seen very good growth in the last 2 or 3 years. This destocking will continue in the third quarter a bit, so there could be some pressure on the revenue growth in ECD in the fourth quarter. But third quarter. The third quarter is generally lower for fans anyway, which was usually the highest quarter for water heaters and consumer appliances because of the festival demand. So that should not be so much of a worry in the third quarter. So ECD will come back to strong growth numbers in the third and fourth quarter.
All right, Mr. Gupta, yesterday at the same time, we had the management of Polycab that joined in here. So I want to focus on the direct competition between that sector itself, the CNW, cables and wires business. Now, you have grown by close to around 19%. They grew by around 11-12% odd. So it's clear that that market share gap you're narrowing, not narrowing, but you have increased your market share. Do you have an updated number? What could your market share have gone to? And also in the Lloyd's business, I recall you telling us that I think you're on the top 3. Has there been some market share gain as well out there? What's the updated number on both these two verticals?
Yeah, overall, if we see in the last 2 or 3 years, we have gained market share in every business. If you're talking specifically about cables and wires, we definitely look to increase our market share both in the underground cables and domestic cables as well. We are not very high on the export business, but definitely our increase is happening in the domestic business. As far as Lloyd's is concerned, we continue to remain amongst the top 3 players in the AC segment, and going forward, not only we hope to increase our market share in the AC segment, but also we are strengthening our position in the other businesses, which is refrigerators and washing machines and LED panels. We're strengthening our position. Still, our market shares are extremely low in that.
Could you give us, according to your calculations, what is the market share in both these two verticals?
Well, in cables and wires, we are around 15%. Okay. In ACs, we should be around 12 to 13%.
All right, 12 to 13% in ACs, around 15% in cables. We take that number on the table, we take that on board. On Lloyd's itself, I wanted to understand that, while you are loss-making at an operational level, you haven't scaled down on brand building, marketing, etc. I remember you were looking to spend about 2.5% of your sales on advertisements this year. Does that number stand? And going forward, how do you plan to scale advertisement going ahead?
I think overall, Havells in the last couple of decades, we've always maintained advertising at higher levels, and that's more of a long-term, build-up of the brand towards premiumization for Havells, towards getting for mass premium levels for Lloyd, and that is a strategy which will continue. A lot of digital spends are happening. We are moving towards tier 2, tier 3 towns, so localized advertising for the rural areas. So this will continue to remain as an investment in the coming years.
So that would be around 2 to 2.5% itself, right?
For the overall revenues, it will be around 2.5% at least.
All right, Mr. Gupta, since you briefly mentioned the rural India, what is your exposure to rural India? I mean, if you have a rough number about the total contribution of your money that comes from there, of your revenues, and have you seen some bit of a slowdown? Because, everyone's talking about urban India doing well, but there are some pain pockets in rural India, is the feedback that we get. Could you confirm?
Yeah, actually, if you look at the last 6 months, the growth in rural markets has been slow. It's also only because of our penetration, which is continuing to increase, that we are seeing growth in the rural areas. But there has been some pain in the rural areas, and that was also because the unprecedented increase in the raw material prices. I think things are stabilizing. We are quite hopeful about the growth in the tier 2, tier 3 towns, as well as the rural India. And we will continue to see this growth coming in the coming times.
All right, and finally, before we let you go, what is the split of your revenue that comes in from metros tier 1, and how much of that comes from beyond tier 2 and rural? And you spoke about penetration. Just wanted to understand how many new touch points have you added this quarter? What's your long-term target out there?
So overall, if you see, rural markets contribute to only 5 to 6% of our consumer business. But if it include tier 2, tier 3 towns, so it's almost more than 50% of our business comes from the non-metros or the non-tier one cities. So that's a sizable portion of that. Yeah, so
retail
I think
touchpoints.
rural India continues to give very good opportunities. We continue to expand our footprint in these areas, now catering to more than 3,000 towns in the towns which is
Got it.
population less